Hey guys, this chapter we're going to discuss performance evaluation for decentralized operations. It says here at the bottom, managers in large organizations have to delegate some decisions to those who are at lower levels in the organization. Okay, so basically we're going to discuss a couple things in these chapters that's going to help us control these decentralized organizations. I'm going to let you kind of pause the screens here if you want to and read what's on these slides. Let's talk about some of the benefits of decentralization. And top management is free to concentrate on strategy. Lower level managers gain experience in decision making because they might be working their way up the ranks one day. Decision making authority leads to job satisfaction. We all like to feel like we're part of something and we can influence. Our work is influential. That's something that most people desire to feel. Lower level decisions are often based on better information because these lower level managers are down in the trenches, and lower level managers can respond quickly to customers. It doesn't take them 3 weeks to cut through all the red tape, right? There also might be some disadvantages to decentralization, and these are some of the common ones that we might see. There might be a lack of coordination amongst managers. Lower level managers may make decisions without seeing the big picture, and lower level managers' objectives may not be those of the organization. So somebody might decide not to do something because it will be detrimental to their division, but it might be beneficial to the organization as a whole. So the term responsibility center is used for any part of an organization whose manager has control over and is accountable for cost, profit, or investment. So there's 3 basic types of responsibility centers. We have our cost center, profit center, and investment center. So a cost center, a segment whose manager has control over cost but not over revenues or investment funds. So service departments such as accounting, general administration, legal, and personnel are usually classified as cost centers, as are manufacturing facilities. They're not typically involved in bringing revenue in, are they? A profit center has more responsibilities. In one of these types of segments, the manager is going to have control over both cost and revenue. So it's not just expenses. Their job isn't just to keep the expenses as low as they can. Their job is to be as profitable as it possibly can. And being profitable means the profit is the difference between the total revenue that's brought in and the total of those expenses. An investment center, even more responsibilities. So with an investment center, that's a segment whose manager has control over cost, revenue, and investments in assets. It says these managers are responsible for adopting strategies that generate solid returns on the capital they are entrusted to employ. So a CEO or operations vice president, they're responsible for generating revenue, they're responsible for controlling cost, and they're responsible for coming up with creative ways to use the investments to create returns on those amounts of monies. Feel free to pause the screen here if you'd like. Service department charges are indirect expenses to a profit center. So it says that services are provided by internal centralized service departments that are often more efficient than services contracted with the outside providers. Service department charges are allocated to the profit centers based on the usage of the service by each profit center. So the idea here is that if one profit center uses more of the service than another one, that they should shoulder more of the expense. And that makes sense, doesn't it? Let's take a look here at a couple examples of service department charges. So we have legal, payroll accounting, personnel, purchasing, information and computer systems, telecommunications, etc. So we've discussed a profit center's goal is to be as profitable as it can, and the cost center's job is to do their job properly but keeping expenses as low as possible. But how would we measure an investment center? And one thing we're going to learn about here is called ROI, or return on investment, and this is going to help us measure the performance of an investment center. So what we're going to do here, we can calculate this return on investment by taking the net operating income, that's our income from operations, and dividing it by the average operating asset. There are two ways that we can calculate return on investment. The easier of the two is this right here. We can take our net operating income and divide it by those assets, those operating assets. The second method here is called the DuPont method. And to calculate return on investment that way, we look at it in terms of two different things. The profit margin, which is net operating income divided by sales, and an investment turnover, which is sales divided by average operating assets. By using the DuPont method, we're able to analyze the return on investment of various divisions. This way we can pinpoint which divisions are profitable and which divisions are less profitable based on return on investment. Instead of looking, you might have different investment center managers responsible for the profit margin and maybe a different one responsible for the investment turnover. So in order to identify who's doing a better job, that's why we would use this DuPont method. We're just able to be a little bit more specific. Here are three of the different ways that we can increase our return on investment. It may not be obvious to managers how to increase sales, decrease cost, and decrease investments in a way that is consistent with the company's overall strategy. So we're going to find here that a well-constructed balanced scorecard can provide managers with basically a roadmap or directions of things that they can do which will help increase the return on investment, right? So here's a couple of different things that we'll find helpful. So we've talked about different ways to evaluate the performance of an investment center, but those were mostly based upon financial performance. So the balanced scorecard looks at things other than just financial performance by taking into account things such as customer service, innovation and learning, and internal processes. Performance measures for learning and innovation often revolve around a company's research and developmental efforts. Below you'll see a couple of examples. Performance measures for internal processes include the length of time it takes to manufacture a product. The performance measures for this particular item on the balanced scorecard may include the number of customer complaints and the number of repeat customers. There can be some problems with using return on investment to evaluate an investment center. And something like this might happen. Here's an example. It says a manager who is evaluated based on return on investment may reject investment opportunities that are profitable for the whole company but that would have a negative impact on the manager's performance evaluation. So for example, the investment is greater than the firm's required rate of return but less than return on investment. So taking on such an investment would be good for the company but would be bad or would reduce the manager's return on investment. So now we're going to talk about something called residual income. That's another way to measure the performance of a financial type of investment center. Let's take a look. So residual income is equal to net operating income minus the difference between the average operating assets times the minimum required rate of return. So this is different. This computation differs from return on investment. Let's take a look here. The retail division of Zephyr Incorporated has average operating assets of $100,000 and is required to earn a rate of return of 20% on these assets. In the current period, the division earns $30,000. Let's calculate the residual income. So we look at the operating assets of $100,000, the minimum required rate of return of 20%. So we're looking at a $20,000 required rate of return. Their actual income was $30,000, so that means the residual income was $10,000 more than the required rate of return. Now, if we use this alone, or if we use return on investment alone, we might run into situations where there's problems and people might not do what's in best interest of the company. And also keep in mind here, if we're using residual income here, that this would be hard to compare divisions of different size because it's not based on the proportion of size, is it? So it's very good to use residual income in conjunction or in addition to return on investment. Let's talk about a couple different things related or issues related to transfer pricing. So if there's excess capacity, it is in the entire business's best interest to do business with itself. If there's not excess capacity, then it does not matter. So if we have a company that has multiple divisions, and if we could buy something internally from a company internally from ourselves instead of having to go to an outside company. If we have excess capacity, if there's idle time, meaning that we're not maxing out, right? So if there's any free time left or capacity left, it would be best for the company as a whole to do business with itself. So have those divisions buy and sell between each other. And when we do buy and sell between each other, those divisions have to use what's called a transfer price. Now, since transfer prices are going to affect a division's financial performance, setting a transfer price is a sensitive matter for the managers of both the selling and buying divisions. Okay, now you can use transfer prices for cost, profit, or investment center. Here's a look here at 3 common methods of transfer price. And we can see here that the price that they set might be as small as the variable cost per unit, the full cost, which would be direct materials, direct labor, variable and fixed overhead, or maybe as high as the market price. By market price, I mean that's the price that the product or service, could be purchased on the outside market. So what's the going rate for it? That's the market. The negotiated price approach allows the managers of decentralized units to negotiate amongst themselves as to what that price is going to be for the transfer. The transfer price should be less than the market price, but greater than the supplying division's variable cost per unit when using this particular approach. As I mentioned before, under the cost price approach, under the cost price approach, cost is used to set transfer prices. Cost may refer to either total product cost, and I mentioned earlier, direct materials, direct labor, and overhead, and this would be both variable and fixed, or just variable cost per unit. And if we just use the variable cost per unit, that would be direct materials, direct labor, and variable overhead. So in this case, that would exclude fixed factory overhead.